Good morning, Mr. and Mrs. Rogers. Thank you for coming in for your initial meeting today. My name is Nick Orlowski. I will be your financial planner here at Rose City Financial, and today we'll be discussing your insurance planning. So you may be thinking, what is insurance planning? So insurance planning is a critical section to any successful financial plan. The best way to reduce the risk of losing a large sum of money in a short amount of time is to obtain the perfect combination of the different insurance policies. Before we make any recommendations or changes to your current insurance plan, let's review what insurances you're currently using. So the first part of your insurances is life insurance. So James has a group life insurance. This policy is owned by James's employer, but is for James's life. This policy has a death benefit of $213,000, which is a little less than 2 years of James's salary. Since it is a group life policy and James's employer owns it, his employer also pays the premium. Since it is not a term policy, James should have access to this policy as long as he is employed there. This is not costing you any out-of-pocket money, so this is a nice benefit for working for Frank's Specialty Pharmacy. The next life insurance policy is James's term life insurance. This policy is owned by James and it is for his life. This policy has a death benefit of $1 million, which is approximately 7 years of James's salary. This policy has a term of 20 years, which means if James were to pass away after the 20 years was up, then Pamela would not receive the death benefit. This policy was purchased in February of 2005, so he has approximately 1 year left until the policy expires. You are also paying a premium of $1,100 a year to have access to this plan. Next, we'll discuss disability insurance. The group short-term disability policy is owned by Frank's Specialty Pharmacy, and the benefit is 50% of James's salary. If James were to get injured or disabled, he would receive $6,000 a month for 5 months. He will have access to this policy as long as he works there, and since this plan is owned by his employer, you do not pay any premiums. This is also a nice benefit for working for your employer. Next section is property and casualty insurance. The first policy that we'll be talking about is homeowners insurance. It looks like you have a homeowners insurance which is owned by both of you. So if one passes away, the other will still be in effect. It also looks like you renew it yearly. You have property coverage of $650,000 with a deductible of $6,500. This covers the house itself if it were to be destroyed in a fire, flood, tornado, etc. The most you would have to pay out of pocket is $6,500. You have personal property coverage of $175,000 and a deductible of $500. This covers any of the contents inside the house if they were to become damaged or destroyed. Your policy will cover all contents up to $175,000, and the most you would have to pay out of pocket would be $500. The final part of your policy is a liability limit of $250,000. This will cover the cost of any legal fees, lawsuits, and damage to the property for up to $250,000. Continuing on property and casualty insurance. James's car insurance. It looks like you both own the policy on James's car and it renews every year. Both comprehensive and collision deductibles are $1,000. Your collision coverage is the same as the deductible, which is $1,000. This covers the damage to your car after a collision, no matter who is at fault. You have a property liability limit of $50,000. This covers any damage you cause to someone else's property, such as their house or car, up to $50,000. You have a liability limit per person of $50,000, meaning that if someone is injured and has medical bills worth more than $50,000, you must cover the difference. You have a liability limit per accident of $150,000, meaning that if all people in the car are injured and their medical bills are worth more than $150,000, then you are responsible for the difference. Next, we'll talk about Pamela's car insurance. It looks like you both own the policy on Pamela's car and it renews every year. Both comprehensive and collision deductibles are $500. Your collision coverage is the same as the deductible, which is $500. This covers the damage to your car after a collision, no matter who is at fault. You have a property liability limit of $50,000. This covers any damage you cause to someone else's property, such as their house, up to $50,000. You have a liability limit per person of $50,000, meaning that if someone is injured and has medical bills worth more than $50,000, you must cover the difference. You have a liability limit per accident of $100,000, meaning that if all the people in the car are injured and their medical bills are worth more than $100,000, then you are responsible for the difference. So James and Pamela's car insurance policies, y'all are both very similar in the aspect of how it works. However, there are just some discrepancies in the dollar amounts. And then the final property and casualty insurance policy is the RV insurance. Your RV insurance policy is very simple and does not have very many parts to it. You pay a premium for it, and it is annually, and there's a policy amount of $50,000, and that's really it. So next, we're going to move on to health insurance. You do have a high deductor employer plan through James's current employer. So according to the case study, your current health insurance plan is a high deductible. This means that your deductions is most likely 4 figures, so you want to make sure that you have enough money saved up in case of a medical emergency. In turn, the monthly premiums are cheaper for this plan since it has a high deductible. And one way that you can help combat this high deductible is purchasing an HSA, and we'll talk about that in one of the later sections. So now that we have reviewed your current situation, we'll move into the next section of our meeting today, and that will be what I personally recommend that you should do concerning your insurance policies. So first up is life insurance. I would recommend Pamela get a new group life insurance, and this is because based on your cash flow troubles that we diagnosed in the financial statement analysis, I would recommend Pamela go back to work. This would give her the opportunity to obtain life insurance through her employer. I would recommend this because if Pamela were to prematurely pass right now, then her final expenses, such as a funeral, would not be covered. I believe this would help bulletproof your financial plan and protect your hard-earned assets. The next thing we'll be discussing is James's group life insurance. I think that your current death benefit of $213,000 is far too low. Most employers offer a minimum of 3 years worth of salary as the death benefit. So my personal recommendation is that you should discuss this with your employer about potentially increasing your death benefit. And I would also recommend adding a contingent beneficiary to this policy. Adding a contingent beneficiary just means that it will eliminate the death benefit going through the probate process. And then James's term life insurance. Similar to the life insurance policy at his employer, I would recommend adding a contingent beneficiary. The contingent beneficiary receives the death benefit if the primary beneficiary is deceased, unable to be located, or refuses to accept the inheritance. Adding a contingent beneficiary is another step of your financial plan that makes sure your assets go where you want them to go. I will elaborate more during the estate planning section of your final plan. So next we'll talk about disability insurance. In terms of the group short-term disability insurance that we talked about in the current section, I do not see anything that needs to be changed for this policy. Everything looks suitable for your financial situation, and I would recommend keeping it the same. However, I do recommend a long-term disability insurance, which you do not currently have. There's no long-term disability insurance on your current plan, so I would suggest adding a long-term disability insurance plan. Your current plan has a short-term disability for 5 months, so I would recommend a long-term disability plan that has an elimination period of 6 months or less. So this is whenever the short-term disability insurance stops paying, you will not have a pause in income. And then additionally, for the property and casualty insurance, I'll talk about the homeowner's insurance. I would recommend increasing your liability limit from $250,000 to $500,000 or double it. This will add a little bit more protection in case you were to be the victim of a lawsuit. It is very possible that someone could sue you for more than $250,000. This is why I recommend increasing your liability limit so you will not owe a substantial amount of money out of pocket. Other than that, everything looks good. I think you're well protected and have nothing to worry about incurring major expenses in the event of a disaster. Next is James's car insurance. I would recommend increasing your car insurance plan since most new cars are worth more than $50,000 today. With your current plan, if you crashed into a car worth more than $50,000, you would owe the difference. Thus, I would recommend a 250, 500, 150 insurance plan. The monthly premium that you pay will definitely increase, but I do think it will be worth the increased protection. Moving on to Pamela's car insurance, like James's recommendation, I would also recommend that you increase your car insurance plan. You actually have a lower insurance plan than James. I would recommend getting the same insurance plan that I recommended to him, which is a 250, 500, 150. Just like James, the monthly premium that you pay will definitely increase, but I think it is worth having that increased protection. In terms of RV insurance, I would recommend selling your RV to accomplish your financial goals, but I will discuss more of that in the later sections. As far as insurance is concerned, I would recommend keeping your current plan. It looks like you do not pay any premiums on it, so it basically is free. Your policy amount is for the value of the RV, so you would not owe any money if you were to crash it. So next, let's move on to health insurance. High deductible employer plan. I would recommend not changing this plan nor individually finding a plan. However, like I said earlier in this meeting, I would recommend using an HSA or FSA to help cover medical expenses. These are tax advantaged accounts, so you will be able to direct some of your money towards medical expenses rather than pay taxes on it. As far as all that goes, I was just adding on or modifying your current plans. So this section I will be talking about adding new plans that you currently do not have. So the first one's an umbrella policy. I would suggest anyone to have a personal umbrella policy or a PULP. I would recommend a $2 million policy. You may think this will be very expensive, but it really isn't. The purpose of this policy is to provide excess liability coverage and legal defense for liability claims that may arise that exceed the limits of the underlying homeowners and automobile policy. The PULP also covers the entire family and fills in the liability gap that exists between the homeowners and automobile policy. Next, concerning new plans, I would like to recommend a long-term care insurance. You do not currently own a long-term care insurance policy. Because long-term care expenses can be very expensive, I do recommend you purchase a plan. You cannot wait to purchase this until you need it. You will not qualify for it. So you're able to purchase it during your 50s and 60s, and according to data, 70% of Americans will need long-term care at one point in their life. Purchasing long-term care insurance will help protect your savings. So in conclusion, I modified 7 current insurance plans and recommended adding 4 insurance policies. I believe if you follow my recommendations, your financial goals will be much more likely to happen. And I believe this is because having a good insurance plan is crucial to preserving your hard-earned wealth and being able to use that obtained wealth in areas that you desire. So, Mr. and Mrs. Rogers, thank you so much for joining me today. Thank you for your patience, and I look forward to hearing from you soon. Thank you.